And welcome everyone. We're here to talk today about the active ETF market and the growth in that market. And so we thought we'd just start by sort of level setting in terms of the number of products out there and assets. I think the growth of active ETFs was largely triggered by the ETF rule from the SEC in 2019, 6011, which obviously allowed ETF providers to not seek the exemptive relief process that they previously had to in most cases when launching new products. So as of now, or as of September 30th, Morningstar reports 1,229 active ETFs on the market. That's versus 1,970 passive index products. And in terms of assets, that's about $439 billion, which is about 6.1% of the $7.2 trillion in ETFs overall. So lots of room for growth. And here to talk with us about this is we have a panel of, I'll just go left, right on my side, Eric Pollackov of Invesco, which is global head of capital markets and ETFs at Invesco, joined in 2016 from Schwab. Dan Muzzarelli of the head of ETF sales at Franklin Templeton, and he also had worked at iShares previously, and James Erceg, executive vice president of product at Harbor Capital, prior to which he was at T. Rowe Price. So thanks very much for joining us, gentlemen. Appreciate it. And great. And as mentioned, if anyone has questions throughout the webinar, we'd love for you to drop in the chat so we can address them. But without further ado, we could get rolling. So let's start with talking about the interest in active ETFs and who the buyers actually are. So Dan, Franklin has about $5 billion in active products, right? And that's about 40% of your $13 billion ETF family. So I was wondering if you could talk a little bit about the demand and what kinds of uses you're seeing and clients are most attracted to these.
Yeah, happy to. And thanks for having me. As I look across the landscape, certainly within our firm, we've got a very diverse client base, whether that be through some of the acquisitions we've had over the last 3 years or, the 70+ year history of the firm. When you think about providing solutions to clients, wherever they may be, certainly the ETF wrapper, it's sort of hard to ignore the growth as you outlined. So, when I think about the types of clients that we work with, it spans from individual buyers, right, which certainly during the last few years, especially during COVID, we saw quite a boom there in terms of individual investor activity, all the way up to the largest pensions and endowments that we work with. So, I think certainly a broad spectrum. At least in terms of our client base, we're probably about 60% institutionally driven versus about 40% more, retail and financial advisor driven. So, relatively even split there for us. But I think, in terms of the demand, you've seen quite a bit of diversity in terms of, what folks are looking for. And then, as you said, it's hard to ignore the migration that we've had sort of, in terms of vehicle diversification, both from an ETF and mutual fund lens into other structures as well. And then certainly, I think active is now sort of launched, as you said, or catapulted the ETF into another stratosphere beyond just being synonymous with passive.
Great, thanks. And Eric, right now Invesco has about 11 billion in active ETFs, no? And that's about 2.8% of your assets in ETFs overall. Obviously, Invesco has a long history in the ETF market, including the sort of interim step of active ETFs with smart beta, et cetera. Wonder if you could talk a little bit about what you see the drivers of growth.
Yeah, we're a little bit long in the tooth in this subject. We were the PowerShares, which was acquired by Invesco in 2006, was actually the first to file for an actively managed ETF in 2008. Wasn't the first to launch, was beat out by another firm that subsequently closed, but nonetheless, it's something that's in our DNA to begin with. I think the growth comes from really portfolio managers understanding on the mutual fund side that the ETF wrapper is just generally a better technology with regards to investment merits, with taxes, transparency. We talk about all the tax efficiency things and the intraday tradability of the ETF. So all the some basic tenets that kind of came with the growth of index-based products kind of do translate essentially into the actively managed space just as well. So I think that's where the growth will come from. You've seen graphs of this where it's like 1.3 trillion out of actively managed equity mutual funds and 2.2 trillion into actively index-based products in the ETF wrapper. So I mean, it's literally, it's like that weird graph where it goes, left to right and down to the right as well. So I think overall, though, that's where the growth will be coming from.
Great. And James, if you could talk from the Harbor perspective, obviously a long active history as an active manager, and you all, your largest strategy started with not really an active lineup. And can you talk about kind of how you moved into the space and how you built that?
Sure. So when I first joined Harbor not quite 4 years ago, one of the commitments from the executive team was to broadly be vehicle agnostic. And one of the tenets was to enter the ETF market with a committed effort. And so, as you mentioned, we are primarily a we have a sub-advisory model. We're not vertically integrated, so to speak. And so the focus was on identifying what sort of strategies to launch with. But let me back up, because one of the comments that Eric mentioned, I think is worth highlighting, is when you look at the trend of investors who've adopted or who've embraced index-based investing, and you compare index mutual funds to index ETFs, you can see when given the choice, the flows to index ETFs is much greater than mutual funds. And so, if the basic premise was, if that's true for indexing, why would that be true for active as well? And now there's all sorts of sort of frictional reasons why the adoption of active may take a little longer. We may get into that later, but I think in the big picture, if it's good for indexing, it's going to be good for active as well. And so that's what brought our focus toward entering the market. And to your point, most of our offerings are traditionally discretionary active, but we do have index options as well.
Great. So staying with you for a minute. I mean, the active managers on the ETF side, on the mutual fund side, have been under a lot of pressure in recent years for lots of different reasons. And I guess, when product providers think about launching active ETF versions of their strategies, is it a zero-sum game? Are you moving money from one side of the house to the other? How do you think about that? I mean, would you compare it to the DC market? We've seen some product differentiation there, and I'm wondering if you could address that.
Yeah, so I'll address it real quick, and then others I'm sure could chime in as well. So it's not the same thing as in the CIT market space, I would say. So in the CIT world, it is a much clearer copy paste in terms of the investment strategy can convey to the new vehicle, the collective investment trust. And that over the last decade, there's been tens of billions, if not $1 trillion of conversions that have happened from mutual funds to collective trusts. Interesting side point is that collective trusts now are actually larger than even mutual funds in the defined contribution space. So that is an enormous substitution effect. Contrarily, in the active ETFs, I think it's mostly new money. And I mean, there could be some on the margin where a little bit of cannibalization, but I think shout out to ISSMI and the Investment Company Institute. I was at a recent event with them, and they presented some data that showed, by and large, there's not cannibalization. It's active ETFs are probably taking away from active mutual funds, if anything, or new money just being allocated to active ETFs.
Okay, great. So Dan, can you talk about what you've seen with flows? I mean, your core bond ETF has about $1.5 billion in it. Franklin Income, a newer launch, had 97 million as of the end of September, according to Morningstar data. So where do you see the money coming from?
Yeah, actually a little over 1.7 after this week. So moving in the right direction.
No, 9:30 data, sorry.
Yeah. Hey, we'll take it wherever it comes. But no, I think, as James alluded to, I think it's interesting to see some of the evolution. I've been in the ETF industry for longer than I care to admit, certainly last, call it 15 years. But, I think it's been interesting to see sort of the migration. We actually saw sort of watershed moments along the way too, in terms of when folks were getting in. 2008 actually ended up being kind of a pivotal year for fixed income ETFs, interestingly enough. So again, I think you sort of see even the proof case from a wrapper perspective, and then again, this is part of that evolution. So I think there is sort of certainly the case for differentiation as well. It's interesting in kind of putting them in reverse order, but Franklin Income, obviously a flagship strategy, a long and storied franchise that we have here at the firm, $80+ billion in assets across vehicles. Certainly mindful in launching the ETF earlier this year. So INCM has been, just shy of, I think, 100 million. Certainly it's an income-driven product. So, NAV declining and yield coming up a little bit given the environment we've been in the last few months. But, where we've seen flows coming from is actually largely people who walked away from the mutual fund franchise maybe 4 or 5 years ago, liked the idea, but went to an ETF-based portfolio, right? Whether that was for fee-based reasons or whatever it was. Again, all the benefits that Eric talked about. I think it's interesting that we're actually now starting to see some kind of recidivism in terms of the folks who like the team, like the idea, see the fundamental sort of reason to have it in a portfolio. And then now the vehicle certainly is attracting new flows. And I think, again, to the core bond strategy, FLCB, our largest strategy, I think, a lot of our product ideation early on sort of centered around a couple of different pillars. But, this idea of kind of active and an extension of active, but beyond passive, right? So being benchmark aware, I think is certainly for some of our larger clients in the institutional space. They have certain tracking parameters that they're concerned about. So taking an active bent, but without sort of necessarily deviating too far away from that stated tracking error, right? So giving them an expectation of what that'll look like, I think, and then at a reasonable price and in an active strategy, right? That starts to become attractive, I think, for folks as they kind of evaluate options within the wrapper net.
So Erica, as we discussed earlier, Invesco has, long history in the ETF space. Your ETF assets are as the same size as all of the active ETF assets in the industry overall, including index products. So just kind of curious what you're seeing, where these ETFs are pulling, the active ETFs are pulling from, and what you see the mutual fund ETF product split, how that you see that going in the coming years.
Yeah, I think James and Dan kind of nailed all the sources of funds. Some of it's new, some of it's from active, some of it's from stock, individual securities. I think it's a blend of all of them. But I would just say that I think going forward that the mutual fund industry launches are drastically down, while actively managed ETFs are drastically up. Actually, I had to do a presentation last week down at a conference in Texas, and I had to talk about active ETF launches. And I literally had to go back 3 years and make sure that the numbers were right, because 70% of actual all ETF launches in the last 3 years have been actively managed. And I think that's a progressive of our industry, thinking about what's next, right, for our investor base. And I think that's really where the industry goes. I think mutual funds overall are going to be suffering for quite some time.
So I guess not to, but we said before about 6% of ETF assets are active currently, but 70% of launches. How do you see? Yeah, how long do you think it takes for? I don't know about equalizing, but how long does it take to kind of get greater traction?
Yeah, so when we think about actively managed ETFs, like some of these things are kind of we take it a little bit for granted, right? It's not always just like the Peter Lynch's of the world or the Bill Grosses picking bonds, right, or stocks, right? It's some of these things that just have maybe an active option overlay, but that really kind of is driving some of this growth. The other thing that's really interesting to watch is sort of like 10 years ago, if you were an investor institutionally and you wanted, say, Russell 2000 exposure, but a 10% cap on losses, like you had to go to a bank and have a structured product created for you. What the ETF industry has done over the last, I'd call it 5 years, is kind of recreated that in an ETF wrapper technology that now allows for RIAs and individual investors to have the same sort of access to these strategies that, essentially were really institutional only. And I think that's the growth cycle that we're just in the first inning or second inning in my opinion, on with regards to new products and innovation there.
Great. And you know, as with everything in asset management, distribution is kind of the name of the game, right? So can we talk a little about due diligence and working with intermediaries and how what you all see in that space? I mean, are they using for active ETFs, are they using metrics similar to what they use for active mutual funds? I mean, are there concerns about, you know, there are different concerns about the vehicle and spread, et cetera. So, I mean, Eric, can we stick with you for a second? Can you talk about, you know, you've talked about how RIAs play a major role in building the business. Can you expand on that a little bit and what you see?
Yeah, I mean, if we think about mutual funds specifically, right? You know, first index-based mutual fund was 1975. First mutual fund offered to the public was 1924, right? Like, but the issues that advisors particularly saw then was they wanted to see track record and they wanted to see the portfolio, and those things took time, sometimes 3 years, right? Depending on Morningstar ratings, et cetera, so on and so forth, right? Well, when it comes to the exchange traded fund, because they're a daily mechanism, right, that are fully transparent, you can see bid-ask spreads, you can see assets under management, you can see trading volume, you can see all that every single day. I would opine that that 3-year window is now maybe 6 months, right? In terms of what, you know, what the advisors particularly want to look at. So again, this industry in ETFs in this country was completely built upon the backs of RIAs down. Institutions didn't really start talking about ETFs until the mid 2000s, I would opine. So I think that's where, you know, the cycle on top of the adoption rate is really kind of focused really on the RIA space.
So we talked about RIAs a little bit, but Dan, can we talk about broker dealers? What happens when you have a product with scale and you show up at, you know, a wirehouse or an independent and go to the research team? You know, what are they looking for? What are the metrics they want?
You know, I think there's some consistency and then there's some inconsistency, right? I think, you know, it's certainly you know, a job that I think is tough and getting tougher, right? I mean, we talk about the proliferation and the number of products. You know, I think some firms have staffed for that, some haven't. So now you may have, you know, quite literally hundreds of products that are being added that you're then being asked to, you know, have research coverage of. So, you know, I think we've actually taken a couple of different approaches. I think with some firms, you know, where we have, you know, longer standing relationships or where we're, you know, potentially a large revenue sharing client, always trying to be thoughtful before we even launch a product to say, hey, like, you know, what are you thinking about? We don't want to cannibalize anything. As I mentioned earlier, right, we're trying to attract new folks into the wrapper and bring folks onto the platform. So really trying to think through, you know, are we going to have any Reg BI issues, right? I mean, obviously fee comparison, if we have a similar team, you know, Franklin Income, again, a good example for INCM, you know, we want to make sure that we're pricing relatively the same. You know, maybe we can talk about economics at some point, but, you know, that obviously looks different for us and for some of the intermediaries. But, you know, track record always is at least something of a discussion around active, right? Again, it'll depend a bit on the team, how long they've been together, what the strategy is. You know, size of the overall fund, right? There are hurdles that are 10, 50, 100. Again, it varies a lot from firm to firm. Some firms look at average daily volume, some don't, right? NAVs being a little bit different from product to product, right? I would argue a penny spread in a $10 ETF versus a 10-cent spread in a $100 ETF, right? If somebody says I need 2-cent spreads, that's, you know, again, those things can kind of be again, arbitrary at times, right? So we're always trying to think through. There's a massive spreadsheet one of the fantastic women on my team puts together for us and kind of manages. So, you know, always trying to think through the lens of that. But, you know, I think what I've seen certainly in the last 3 years pick up quite a bit is more of the intermediary engagement, right? Understanding how this is going to impact, you know, where are we trying to position this? What are some potential competitors, right? Sort of helping along in that process. And I think, again, from an active lens, you had sort of, you know, index-based things were a little bit easier to measure, right? You could kind of take a look at what the rules were, and there was more predictability. But there's more of a traditional sort of research process now with active ETFs that I think at some places even lives alongside, you know, the mutual fund and SMA folks as well. So, you know, I think leveraging obviously across the firm where we can, where we have those relationships in the other product types, and trying to reduce a bit of that burden for a lot of our intermediary partners.
And James, can we talk a little bit about that? I mean, I think we've talked about sort of the two-step process. You got to get through the quant screens of the scale and potentially the track record. I mean, we heard what Eric said about 3 years might not be what you need, but just, you know, what are you seeing that when you approach home offices? Are you taking specialists? Who's interacting with these people? What are kind of education curves?
So I think just to, I guess, review the two-step process, to Dan's point, it's going to vary by intermediary. Some you could immediately get on. I mean, the Schwabs and the Fidelities and things like that, for retail, individual purchase. So that's kind of straightforward. For the broker dealers and then certainly the banks, it's going to be more idiosyncratic to the firm. But generally, as Dan already articulated, there's some thresholds that the product people want to sort of see in order to largely to screen out, because there's to Eric's earlier point, there's so many ETFs coming to market. They need a simple method to sort of limit how many they can actually approve and they want to approve. And so that it's sort of an easy way for them to limit this flooding of their platform. So there are some metrics, vary from 10 to 100 million, and then if you're active, things like 1-year track record, does it include derivatives? Does it not include derivatives? That could actually be something that they'll take a closer look at. But let's say you get through that product step and you're approved. Then I think your broader question is around, how do you get on either in a model or a focus list and things like that. And the reality is there aren't that many intermediaries that have integrated active ETFs into discretionary models. There are certainly TAMPs and other sort of intermediaries that have traditional index-based ETF models. That's been going on for a decade, or more. But integrating active ETFs is certainly newer. And while there are some places you can pick and identify, it's still, frankly, new to many of the intermediaries to be evaluating active ETFs as part of a discretionary model. But to your point, it's the same, 3 or 4 Ps. People, philosophy, process, and performance. They're going to go through the same types of questions that they would on any other active strategy to evaluate the appropriateness for inclusion in a model, or a focus list or a recommended list or something like that. And yes, we do have specialists to help present, and whether the portfolio manager is often included in a finalist sort of presentation, but certainly specialists are part of the way.
And is that around just kind of, I mean, I imagine a lot of advisors are comfortable with using index ETFs, but the specialists, I mean, is it about the structure of the product and how it may or may not vary from the mutual fund structure?
Usually the specialists are around the strategy. And then we have a separate ETF team that will talk about some of the things that Eric and Dan have already alluded to, the spreads and the trading volume, and there's and Eric and Dan know this, probably been around 20 years, the question, hey, the ETF only has X amount of AUM or this amount of daily volume. Is there really enough liquidity in the ETF to get a good a price, whether a buy or sell? Hopefully it's a buy, and so you have to go through that, and that is always present. And having a specialist team, a specific ETF, typically capital markets, but there could be other representatives that would be answering those types of questions. And yes, we do have that.
Okay, thanks. And so we spoke a little bit about, Dan alluded to the economics of this, right? So ETFs obviously don't have 12b1s, don't pay sub-TA generally. Dan, what have you seen, a lot of legacy platforms do when you approach the home office? So how do you kind of navigate that, especially if you have a similar mutual fund version?
Yeah, and look, I think the reality is, we're in the economics business. So, being as upfront as we can. I think, firms have, and again, this varies from firm to firm, so I don't want to generalize, but, for the sake of brevity, I think the idea is, we're looking to make sure that we're, maintaining scale in our relationship. And again, for some of our larger partners, given the breadth of product that we've got, as you mentioned, we've got about 13 billion in ETFs in the US. We've got, $1.5 trillion, soon to be a little bit more once the Putnam deal closes, of assets around the world. So, obviously there's a lot of other considerations across the different lineups. I think, first and foremost, the cannibalization aspect, right? I think there are some firms that are comfortable with clones, most aren't. So trying to think through the logistics of, making sure we're not taking off something that's in a more normal revenue stream for them via 12b1 or other arrangements, and then kind of replacing that with something that isn't. I think, certainly firms have gotten creative around how we can do that, whether that's sort of, educational commitments, things like that, where we've developed programs for individual firms where it's less maybe, hard dollars back and forth and more, trying to operate around, value added programs that we have. We've got a number of fantastic speakers who, can come in and do practice management, things like that. And then look, at the end of the day, I think, the structure of a lot of those agreements then sort of needs to change and has changed over the last few years. I think the reality of it is, similar to the sell side, right? We're looking at things a lot more in totality and sort of share of wallet, if you will, for lack of a better way to put it, in terms of overall sort of remuneration from firm to firm, as opposed to just sort of, dollars in or dollars out. So, but I think, most intermediaries have been very forward thinking about it. And, I think it's kind of forced us to have a lot more frank conversations. And I think also, we're starting to see firms that maybe weren't as comfortable with active ETFs starting to come to the table. I know I've had conversations and am having conversations with different firms around, what that might look like. So I think, everyone's at a different point, so to speak, in terms of their kind of coming towards it. But I think it's pretty much hard to ignore at this point, given, again, I think over the last 3 years, something like 10% of all of net ETF flows are coming from active. Over the last year, it's closer to 25%. So, the reality is a lot of that, as Eric mentioned, is coming from mutual funds, amongst other places. So, I think most folks are realizing that they need to get ahead of it.
And so, Eric, can you talk a little bit about just sort of how you look at picking partners and where it makes sense to bring the active ETF to a distributor, and what they want to offer and what you can provide?
Sure. Yeah. I mean, I think Dan nailed a lot of it, quite frankly. But I think now that we're in a no transaction fee world, the economics have changed drastically. And understanding where your ETFs are and the owners are has always been a challenge since 1993 to today. It's still been a challenge for us to understand that. So there are ways for remuneration around, finding out who your investors are on these platforms. I think that's probably the number one economic, incentive for them. But like Dan said, I think that overall, understanding how to be partners with them is the most important aspect of the relationship these days. And whether, like, again, Dan alluded to education, understanding how to talk to their end clients, I think, is an important one. So there's multiple aspects of it, as opposed to before it was, when there were commissions being charged by many of these platforms, it was a very different conversation than it has become since Schwab and others made that decision.
Sure. The question on that point about education and end clients, I mean, what kind of information are advisors looking for to help explain to their customers? And
yeah, so listen, we have 220 ETFs in the United States, right? So there's a full menu of different things depending upon where we are in the economic cycle that we can offer to clients. So that's like the high level. Like, okay, well, what are we doing? Are we in a correction right now over the last 3 weeks? Maybe. Okay, well, here's something you should think about. Maybe look at things like equal weight, for example, or low volatility, for example. And then, on the growth side, we're going a layer deeper. Then you need to really kind of explain how your products work, right? Like what BKLN is bank loans. Well, why are bank loans a good investment right now in this environment? Well, here are the reasons why we think that this makes sense for your clients. So I think that's where, you kind of have to kind of help them educate their own clients, if that makes sense. And their clients are vast, right? And there's a bunch of different understandings within that client base of how ETFs work and how they can help their portfolios. But I think at the end of the day, I think that's the whole goal. I think for all three of us on this panel is really to kind of help end clients achieve their goals, right? And for us, like I said, we've got a whole menu that we can offer to them to achieve those.
Great, thanks. So both Invesco and Franklin have pretty big model businesses. And I guess I'm just kind of curious, we talk about use cases of these and how to kind of get that scale and show the world how these things can be used. I mean, can maybe Dan, can you start a little bit? How is it easier to get a home office allocation? Do you think about including them in Franklin models? What is the good entry point from that perspective?
Yeah, and never easy or simple. But I think the reality is, I think it's a bit twofold, right? So from an intermediary perspective, you can kind of, risk monitors and sort of, incorporating the home office thinking, right? And all of the research that a lot of big intermediaries do into end client delivery, I think makes models attractive, right? And amongst other reasons. And then from an advisor perspective, it's no surprise that you can package things, make delivery simple, right? Take time off of your calendar to do other things, by allocating to, to me, it's almost an extension of active as well, right? You're picking a manager to kind of watch things as opposed to a model where you're using potentially active and passive or some, configuration of the two to then sort of present that. So, I think we have a pretty robust models business within the firm, our investment solutions group. As we look at sort of our inclusion, obviously we almost consider them a client, right? They're, a shareholder of ours, at a smaller percentage relative to some of our other clients. But again, I think we look at it as a good test case for us, right? Because it's sort of a friendlier conversation. And then from an intermediary and sort of broader distribution perspective, I think we're always looking for opportunities to maybe partner, right? Obviously being a large distribution force, that's, part of the conversation we can have, whether that's sort of white labeling things, right? Like we're always kind of, trying to think through the different avenues. But at the end of the day, no surprise that models continue to grow. I think now you've almost seen a similar proliferation to like active ETFs. I don't know, I'm sure there's thousands of models across the industry. I haven't seen statistics there. Well, actually I have, but I don't know how credible they are. But again, the thought process being that, we think of it both from the lens of, we've got 61 products in the US, so not quite where Eric is, but, the idea being that, we've got enough to sort of cover a portfolio so we can put together something relatively simple. We can layer in 10 providers, right? And again, everybody looks at it a little bit different. I think the big lift for us over the last, call it 2-3 years, has been in a lot of the active passive models where, prior to, call it 2019 and sort of I guess that's 4 years ago now, COVID time still, you've seen a sort of proliferation of active ETFs. So as a result, I think the reality is, what was only sort of a mutual fund or largely a mutual fund dominated model base, you're seeing a lot more active ETFs pop up in sort of those blended models.
Eric, are you seeing something similar or?
Yeah, listen, I kind of equate this to like fast food, right? Like McDonald's opened up in the the 50s, I believe, in California, the first McDonald's, and like you could go there, get a hamburger quickly and leave. Then eventually a drive-through came in like the 70s, right? So you didn't have to get out of your car. You can kind of pick up your food and keep on going. And then Blue Apron went public, I don't know, a few years ago, where you can actually get boxes of a week's worth of food, right? Delivered to your home for a price. So I think the model business has kind of really done that, right? So the ETF first kind of came out in 93 and in the US, then you kind of started having model being built, in the late 90s, early 2000s. And really it's like Dan pointed out, it's just an ease of use case. And to his point as well, like we have a significant models business. They are a client of ours, as the asset manager. We help them think about product development, and they help us think about product development. So I think it's a symbiotic relationship and a test case, as Dan alluded to. And then again, it's like sort of the holy grail, right? Like if you can get onto some of these wealth media intermediary models, that's where you want your product to be, right? Because it's consistent generally on kind of assets gathering and relatively sticky assets.
Great. James, I mean, some of the very fast-growing active ETF providers, like for example, JP Morgan, have captive distribution. When you don't have that, what do you look at as an entry point?
So part of it, yeah, great question. So there's probably a suite of different approaches. On the active side, I think it's still somewhat traditional in the sense of, do you have conviction in the strategy itself, and why do you think it's differentiated and durable? And pricing as a component to this as well. And then putting aside the clone versus non-clone issue for a moment, and just sort of you have to have conviction in the durability of the strategy. And to some degree, it is very similar to active mutual funds. You have to build the track record and show and demonstrate that the investment thesis is durable, like you have conviction in. And so I think there's some element of similarities between active ETFs and active mutual funds, and that's just true of active in general. On the other hand, with index, there is an opportunity to promote, the back tested and the methodology and the systematic nature of indexing. And I think that accelerates and kind of truncates the scalability of it. And in some cases, this is where institutions in particular, in fact, our largest ETF is backed by one of the largest state pension funds, and partly because of, that, index and systematic nature is easier to sort of understand and perform that attribution and you just have a better understanding of what you're investing in. So I think it depends is the short answer, but you have to have conviction in the durability of the active strategy, and then it's RIAs. I would say, just as a real quick aside, where is active ETFs being adopted the most? It's clearly RIAs. I mean, I think Eric alluded to this earlier. Just they've kind of they've been the canary in the coal mine and have driven ETFs from the get-go. And you can really see it in the data that they are the early adopters of active as well. And so that's the natural audience that we have gone to as well.
And I can testify. I'm at Schwab Impact today, and I can tell you the exhibit hall is filled with active ETFs. But that's a good segue into product structure. So both Harbor and Franklin have gone with the full transparent model. James, do you mind just starting? Was there why did Harbor choose to go that direction? And then secondly, were there any kind of concerns from the portfolio management team? I mean, the traditional fund managers who kind of had concerns?
Yeah. So we made the decision very early on that we were only going to pursue a transparent, basically follows 6C11, and I think, and we're not changing or deviating from that view. I think in the end that is the better model, frankly, and partly because I'm not personally convinced, and I don't think as a firm we're convinced that it's solving investors' issues per se. But I think at a high level, we were convinced that the transparency is just the long-term preferable route. Now, to your point about identifying prospective sub-advisors, I think in our discussions, in fact, all of them were very open to it. I think the things that they were concerned about were around cannibalization, frankly, and particularly with scaled businesses. And but the way we go about our manager selection process, we call it Alpha Edge. We identify, we have a very rigorous quantitative, a very rigorous qualitative and process, and we tend to find entrepreneurial firms that have very focused disciplines and processes that are all around self-improvement. And so when we talked to these firms, and again, they tend to be entrepreneurial boutiques, they were particularly attracted to the ETF because it was a growth opportunity. It was early in the market cycle, and so they found that to be extremely compelling. So I would say in general, for the size, for sub-advisors of size, their concern was around cannibalization, although they had gotten over that and have partnered with us. But by and large, it's the boutiques that have found the growth potential as being the most attractive attribute.
Great. Dan, what about at Franklin? I mean, again, fully transparent model. Any concerns with your investment teams since they've been trained with the at least a quarterly lag prior?
I think there's definitely some discussion. I think ETFs in general were a bit of a new concept when I started here a few years ago. So, there was definitely a lot of conversations, and then obviously, the invention sort of the non-transparent wrapper now, and the several different versions that there are. So, I think from our perspective, we were able to get folks comfortable. I mean, it's a relatively limited sort of opportunity set in terms of non-transparent wrappers and what can be in them at this point. There's some sort of operational complexity to them potentially, right? For lack of a better way to put it. At the time, I think when we were first sort of evaluating it, some of the home offices were talking about, slower sort of potentially adoption. As we talked to some of our large institutional clients, it sort of didn't matter to them one way or the other. So, I think from that lens, we just didn't see a reason to sort of go down that path. I say that, and then of course we're about to inherit a number of them in a few weeks. So, I think the reality is, we don't really have a lot of client demand for it. So it's been more of an internal discussion about comfortability than it is sort of an end market clamoring. If that makes sense.
So Eric, Invesco has both, and has for a while. So could you talk about what you're seeing and where you see sort of the greatest reception among clients?
Yeah. So, I mean, transparent active is clearly the winner. That's evident, right, in terms of asset gathering. We launched 4 active non-transparent. We have since closed 3. For us, I think it was more of a challenge to the firm. We kind of thrive on innovation, and we thought this was a good idea at the time to kind of think about how to shield a portfolio. But what the reality was is that the lane that you were allowed to play in was severely limited by the SEC and their mandate, right? So if you think about, they were only allowing U.S. equities or anything that traded contemporaneously with the U.S. equity markets. If you look at like the SPIVA numbers in active management, where's the worst performance? It's generally large cap U.S. equities, or mid cap's a little bit better, and small cap gets even better than that. But again, it's still just a difficult spot to play in. Our thinking at the time was this will expand to other asset classes where we think active management can be much more, better usage and better generation of alpha for our end clients. But since that, we still have one out there. The industry, I think, has kind of voted with, or lack thereof, with their dollars, right? It's only $6.5 billion amongst, I think, 50 products. You don't see a proliferation of them coming. And again, I think one of the natural aspects of what we've touted prior to active non-transparent was transparency, right? Was one of the great attributes to the ETF wrapper. So therefore, I think others, including the folks on the panel, have kind of seen the same, and think that active, in a transparent vehicle probably makes more sense.
Great, thanks. And I'm going to pause for 1 second just to remind everyone that if there are any questions from the audience, please drop them in the chat, as we have about 15 minutes left, but I have more questions on my own. So, but I don't want to steamroll. Anyhow, so I think that's a good segue into kind of how you think about launching products, right? There are a few different paths. You could take launch a brand new product, convert a mutual fund into an ETF. And then the other, Fidelity yesterday filed to launch ETF share classes of their existing mutual funds. That's obviously something that Vanguard has been doing for a very long time and had a patent on that's about to expire. So, obviously interesting. But I guess I'm kind of curious, maybe Dan, you spoke earlier about the distinction in portfolio crossover. And when you look at your mutual fund and your ETF and, going to a distributor saying these guys aren't that dissimilar, what do you think about those 3 options?
Sure. Yeah, no, and I think we've certainly taken both of the first 2. The third, we're still TBD. I think interested to see how that goes. We in Canada, where the rules are a bit different, we've actually taken a similar approach. Obviously, patent less applicable there, but we've now got ETF share classes of our Canadian mutual funds. So a bit different marketplace than the US. Not something that we've really, at least publicly talked about. So. I think from the lens of launching new products, again, we look at, first and foremost, other gaps in the market, right? So what is somebody sort of selling in effect to buy this, right? So are we just adding something to the market for the sake of it, right? Are we trying to be relatively novel, or at least, additive from the standpoint of a product development idea? And then, I think from there, looking across the firm to see what capabilities we have. The nice part about being at a large firm is we have folks who are kind of stacked against a number of different things. We have a lot of separate investment managers now post-leg acquisition. So, as one big firm, we've got Western, we've got Clearbridge, we've got Royce. We've got a whole host of folks who are all now looking at, differentiated strategies in addition to the standalone Franklin ones. In terms of mutual fund conversions, we actually have our third coming up in just a couple of weeks. The Franklin Focus Growth Mutual Fund is converting to ticker FFOG. It's run by the same gentleman, Matt Moberg, who runs our Dynatech strategy and a whole host of other things. So again, tens of billions of dollars following those strategies. Our approach has been, though, to look at a mutual fund that maybe hasn't gotten its due, right? So in other words, kind of diamonds in the rough, so to speak. And for whatever reason, whether it's structurally or from a timing perspective, or there's something else within the firm, we feel like they're great strategies, right? They're highly rated, their performance is, good and great. And then trying to sort of use the conversion as now a new avenue to bring new clients to the strategy. I've seen a lot of different approaches across the industry in terms of conversion. So don't want to comment on anyone else's strategy, but certainly from our standpoint, we've tried to be very methodical about bringing those things to market. And then, also looking at the investor base, right? Like we don't want to adversely affect investors ever. So if we have a lot of, retirement assets, for example, sitting in a mutual fund, that's going to make it a lot tougher for us to convert because, those folks aren't going to have a readily available way that it creates a taxable event and a bad experience for the end client. So, always trying to kind of think through the logistics of kind of avenue two, if you will, as we're looking at potential conversions too.
When you look at that idea of not cannibalizing, so back to the first point about not cannibalizing an existing fund, having a strategy that's somewhat distinct. I mean, where do you kind of walk that line between having a strategy that's distinct enough, but also you can kind of like say, yeah, we know how to do this, because you have something very similar to get distributors and advisors comfortable?
Sure. Yeah. And I think, the easiest and kind of the simple answer is we go talk to them, right? I mean, we had a number of conversations, sort of preemptively to launching income, which I mentioned before, and kind of thinking through, again, we have this long storied franchise within the Franklin Income Mutual Fund series. We don't want to disturb that. So, at what point would you be comfortable, right? And we're not trying to create a clone and sort of just walk the other side of the line, but the other thing for us too is how could we make the case to hold both of these things in a portfolio? Can we differentiate it enough that there's actually some net benefit to even including both of them? I know that kind of sounds cannibalistic in nature, but we do want to make sure that we're differentiated enough that, both from the client experience, from the advisor experience, or, from a compliance experience, making sure that folks are kind of comfortable. And that varies from strategy to strategy, right? I think, for some of the Clearbridge strategies, like I mentioned, LRG is our large cap growth ticker, right? We have a more stated ESG benchmark for that strategy in particular. Again, starting with a similar universe, but now adding a new screen from a portfolio manager lens to be able to kind of take that out and now, have a truly differentiated strategy from kind of the SMA and mutual fund wrappers as well. So I think it really is about, first and foremost, what are we bringing to market? Second, having those end client conversations, making sure there's comfortability all the way around. And then third is kind of looking ourselves in the mirror, making sure that we're, separating enough that like we as, end investors would potentially hold both of these strategies.
And Eric, I mean, there are special mechanical considerations around ETFs with authorized participants and market makers, et cetera. So I guess I'm wondering if you could talk a little bit about how that impacts or does not impact your decisions in product design and which strategies you bring.
No, it's definitely part of it. I mean, part of the education as we launched some actively managed strategies at the end of last year was the education of a traditional mutual fund portfolio manager, right? Where their processes, while daily, are less regimented around liquidity, meaning that they fully had to be taught on what's inside that portfolio needs to be tradable, right? So there, the arbitrage mechanism can occur, and so you don't have bid-ask spreads that are 100 basis points wide. But with regards to the conversion conversation, we've looked at it very closely. We run a large mutual fund asset base. It gets a little complex when you have multiple share classes, I think, is part one. And part two is does it make sense, right, for the strategy and for the portfolio manager, and then therefore the actual end investors. And those things haven't fully added fully up for us yet, quite frankly. But I think that, as Dan alluded to, it's like what makes sense from a product design perspective is definitely part of the consideration is really around the liquidity provision for an exchange traded fund, and the market makers and authorized participants, their ability to interact with the fund it's definitely an ingredient to the success of an exchange traded fund.
No, I would just add, handed to Eric's and Dan's point about the conversion is, certainly the more retirement assets that are in a mutual fund, the bigger disincentive to think through a conversion, because it almost certainly would trigger, redemptions. And unless the fund is de minimis size or something, and that so but by and large, just a sweeping comment, if the higher percentage of clientele that are in from retirement plans in your mutual fund, that would be a powerful disincentive to convert. And that's kind of to Eric's point about the more share classes you have means the more intermediaries that are going to be impacted by the conversion, which is very complicated for them to execute and for you to retain. So that's a powerful disincentive.
Yeah, and one more thing to add, Hannah, to the conversion conversation. It's not a panacea, right? It doesn't make everything all roses, right? Like if you look at actually the conversions that have occurred in the last 2 years, 40% of them are actually losing assets. And 60% are gaining. So so there is a good track record there, but it's not perfect. And I think that's an important aspect to think about too, from an asset management perspective.
If the strategy is not very successul in the fund, it isn't going to be
probably.
You can just slap a new wrapper on it and sell it. Is that what you're saying?
Right. Okay.
All right. Well, I mean, I guess, and I know, that raises another question with the conversion. There's also the operational complication and potentially regulatory around, if you are collecting 12B1, or, how you treat shareholders in that kind of, once you've announced it, I think that adds a complexity for some, adds complexity. And I know, sorry, James, were you gonna, okay. And I know, none of you are lawyers, but I have just kind of a curiosity about the share class idea of it. I mean, is that something that, how do you think about, if that does sort of, have you considered it, looking at this? I think the SEC still has to go through working through whether they're comfortable with the share class.
I'll jump in. Just I was because I was at a recent conference, I suppose, and this came up, and there are a number of lawyers that commented on this at a very high level. This is, if the SEC were to approve this, it's going to be 2024, if at all. I mean, there's a host of things on their plate that they probably are going to have to address first before even addressing this issue. One that came up yesterday was this idea of swing pricing, and that would be, if they are seriously pursuing that type of regulatory change, that would obviously have a big impact on share classes for this idea. So just in terms of their own prioritization of addressing this topic, it seems like it's probably not at the not at the front. But I mean, in theory, like conceptually, I think that, at least I'm just sharing what the conversation was yesterday, it seemed like the staff was very aware of the essentially regulatory monopoly that they granted
allowed
yeah, exactly, to Vanguard, and are very sensitive to that. And so going forward, it suggests an openness to try to figure this out. There are some substantial issues in their mind, that have to get resolved. But I think as more sponsors consider this and try to engage them, it will create more pressure to get serious on their part to engage.
And I know at some point Vanguard was looking at licensing that out as well, when they still had the patent. But I think what we've heard too is people saying that the SEC, you know, Vanguard may be grandfathered and they may be not as comfortable going forward. So it'd be interesting to watch that. So we only have a couple of minutes left. Again, if anybody has any questions out in the audience, happy to take them. But, you know, just as we kind of wind down, I guess, you know, Cerulli has said that within 5 years, ETF assets will overtake mutual fund assets. And I guess we've seen, you know, largely, you know, mutual fund only shops. So Capital Group's gotten in the ETF business. I think, you know, somebody mentioned the 1924 mutual fund. I think we're talking about MFS. I think they've kind of hinted that they may be looking at ETFs. What do you all see, you know, going forward? I mean, you know, what does that mean for the industry's landscape? I don't know if, Eric, do you want to start?
Yeah. Listen, this train's out the station, right? For lack of a better term, you know, this wave of just, again, I think about it in technological lens. Like, it's just a better technology than a mutual fund or a closed-end fund, and I think it solves for a lot of the things that weren't solvable in those types of wrappers. That being said, yeah, I mean, MFS, you know, Cap Group, I mean, these are significant active managers kind of I don't want to say waving the white flag, but just saying, okay, you know what, I believe in this technology too, right? For lack of a better term. And I think that signifies a real shift in the behavior of their end clients. And I think that's important. And then finally, I think if the retirement nest egg of the 401k platform can be cracked, and it has been to some extent. I mean, I own ETFs in my 401k personally, for the record. It's not like it's unsolvable, but solving for the actual plan sponsors and how they get compensated, or what I call the consultants that manage these kind of like decision-making processes, like how they get kind of paid for with an ETF wrapper as opposed to a mutual fund wrapper, I think is really the only like question that needs to be answered. And I think once you answer that one, the 401k will eventually crack and it will become, you know, an ETF landscape. So those are the sort of the things where I see it going. I mean, I don't see 5 years passing mutual funds. I'm like, if I'm a market maker, it's where I came from in my prior life. I'm like, I'm 3-year bid. Like we're going to do this in 3 years, not 5. So my personal opinion.
Okay, so slightly different spin for James and Dan. I mean, earlier this month, Citigroup noted that only between about 30 and 50% of ETFs broadly, including index, are break even. You know, what does that mean for as you guys think about how you launch products? And I imagine that you guys are all going to be very profitable with your products. So, Dan, you want to take that first?
Sure, I appreciate the vote of confidence. No, I think, you know, part of what excited me about the opportunity coming here in the first place is, you know, you have relatively less overhead if you're not creating new strategies in the ETF, right? So I'm already using sort of the portfolio management and a lot of the piping and, you know, sort of operational complexity of a firm like Franklin. So, you know, there are economies of scale that we get sort of day one, you know, that again, sort of vary from firm to firm. So I think that was a big part of it, right? And certainly goes to profitability. I think it also, you know, as we negotiate with index providers on index-based strategies or custodians on some of the active strategies, or especially internationally, again, we do that as a firm. So I think that helps to keep some of those costs down. I mean, P&L is certainly something that we look at, you know, in terms of when we're launching a product, right? What's the break even? I can tell you that's a conversation that I have very quickly and am often reminded of depending on sort of the part of the firm. But you know, I think the reality is trying to think through, you know, sellability and scalability of a product, right? So you know, how big do we think this thing can get? And then the idea as well being, you know, we need to give a proper runway for something to actually get out of the gate. I think, you know, we've seen again, like sort of the pickup, as Eric said, the train's already sort of left the station here. So I think being thoughtful, again, always looking for client feedback around what we can do and can't do. We've closed a handful of products. We've opened obviously way more, but you know, I think the idea being, you know, is there a marketplace for this, right? Do we have a tried and true strategy that's going to make sense at some point. The market's going to be cyclical. You can't just have a 1 or 2 or 3 year sort of thought process around launching anything. You know, and then again, I think it's just more a matter of trying to think through the logistics of, you know, does it make sense to use something that's more profitable to sustain something that's less profitable as you're trying to sort of grow an overall franchise? And, you know, I think, again, the nice thing about the mutual fund industry, whether or not it's in runoff, is for maybe another webinar. But I think the idea being that there's still a lot of revenue coming from that can then fund other growth areas of the business, and certainly the case for us.
Thanks. And James, I'm going to give you the last word.
Well, I maybe in a little difference of opinion on the retirement side than Eric. I would say that CITs will be the dominant vehicle in retirement, regardless if they solve the issues that Eric's identifying. I agree with what Eric said, but I think the CIT is the dominant vehicle for the future. On the wealth side, ETFs, no question about it, are the dominant vehicle of the future. And yes, profitability always matters, but my quick comment would be there will almost certainly be greater number of closures and things like that in the ETF marketplace, whether index or active. I think it's not nearly as stigmatized as what some people think it used to be. I think that's a bit of the nature of the business. Some things are going to appeal to clients and investors, and some, you have the best expectations. But I think there will be a more natural amount of turnover in the ETF space, and that's okay. I mean, this happens in every other service industry, and that's what our industry is. And so I would fully expect a pretty higher level of turnover of closures and openings and things like that.
Great. Well, on that, thank you very much to my panel, James, Eric, Dan. Thanks so much for all your insights. Really appreciate it.
Thank you. Great to be here.
Thanks, Anna.